for joining us. We are recording the meeting, so something has probably just popped up on your screen, but everybody always asks for copies of the recording. They want to have a chance to watch this again later or perhaps share it with other board members. So I'm just going to run through a couple of quick things before we get started. So as I said, it is being recorded. We'll have lots of time for questions tonight. So Jeremy is going to present and take probably about 45 minutes, and then the last 45 minutes we'll do Q&A so that folks can answer any questions that you want to ask. We'll get those directed to the right person and get those answered. If you do have questions, I'm going to ask that you not use the chat, and I'm going to ask that if you want to ask a question to please type it into the Q&A box and we'll read it for you. Or if you wish to ask your question in person, just raise your hand. So if you wiggle your mouse around, you'll see at the bottom of your screen, there's a little button that says raise your hand. So if we see that go up when we get to the Q&A section, then we'll call on you and unmute you so that you can ask your question. So tonight you're only going to see the presenters. So you'll see Jeremy, myself, Tracy, and Liz. But the rest of you,
my screen, or are you controlling your screen?
Can drink wine and or coffee or whatever it is that you want to drink at home and be in your pajamas and be comfy. We can't see you, so we can't see you and we can't hear you. So anyway, all right, with that, I am going to turn it over to Jeremy and he can start his camera. There's a little bit of feedback there.
Hang up, Jeremy.
Okay.
Yeah, Tracy, hang up your phone. Okay. All right, Jeremy, are you with us?
I am. Can you hear me?
We can.
You can't see me though, right?
We can see your slide. Yep, there you go. You go into slide mode. And we're good to go. I'll turn it over to you. Jeremy, his introduction was sent out, but I'll just say that Jeremy has done a number of audits. His company, Newman and Company, has done audits for us now for, oh gosh, has it been 4 years? And Jeremy bought Cajanet and Company and now owns that and has added that to his wide spread of business, and he does a whole lot for a lot of associations and condos in the state of Washington. So Jeremy, it's all you.
Thank you, Juanita, very much. Good evening, everybody. Very happy to be here, and I think we're taking some questions at the end, which is great. So I will start. Tracy, you've got control, right? Great. So you can move to the next slide if you like. Okay, so we're going to cover 5 topics, 5 areas: financial statements, which is the overall scope; basis of accounting, which is very important to know; fund accounting, which is pretty fundamental to HOA accounting; balance sheet; and income statements. And then we'll take some questions. So the first section is financial statements. What are they? Well, they're written reports. They show, in terms of balance sheet and income statement, they show the results or the state of the financial position at the end of a financial period and the results and performance for a period of time. They should provide enough information that's useful to you as board members, to owners, to banks, lenders, other people, consultants maybe. And they should identify the financial strengths and weaknesses. Hopefully there aren't too many weaknesses, but you should be able to identify those areas when you're reading through the financial statements. You should also have enough information to be able to try to draw some conclusions regarding relationships between certain balance sheet accounts and income accounts and expense accounts, and hopefully find yourself with a better insight into the financial position and performance of your association. Okay, fundamental to understanding what's going on with your financial statements is to really have a good grasp, or at least minimum, pretty good knowledge of what a basis of accounting actually means. It's really important to know the foundation of what you're looking at. What do those numbers mean? Are they accurate? What do they include? What do they exclude? So basis of accounting really help you identify the accuracy and completeness of the financial picture. And I think when anybody's looking at a set of financial statements, I think we all want to know that what we're looking at is a complete picture. It's not just what someone decides they want you to see. Accuracy of the reports will show what your assets total is, all the different components of your assets, the liabilities, the equity. Those three pieces are the main parts of the balance sheet. And then your revenues and expenses, which are the big pieces of your income statement. Then you're going to look in the monthly financials, you'll look for a comparison of actual results to budget. Basis of accounting really helps you make sure that you've got reliable and comparable financial statements. So the comparability bit is so important, because if you're looking at month to month or year on year, maybe a 3-year trend, you want to know that the financial statements have been presented and pulled together, compiled in the same way with the same method over time, or else you might be comparing apples to oranges. So a lot of people have heard of GAAP, because I hear people saying, hey, is that GAAP or is that not GAAP? And not many people know really what it means. So GAAP stands for Generally Accepted Accounting Principles. They're rules, a set of principles put together by the Financial Accounting Standards Board, which is a national body. Big thing to remember with GAAP financials is that public companies have to file financial statements under GAAP, okay? So any guesses on what the basis of accounting is under GAAP? There's only one accounting basis that's considered to be a generally accepted accounting principle. Okay, I'm not hearing any voices or seeing any hands. It's the accrual basis of accounting, and we'll touch on that in just a minute. Okay, here we go with some basis of accounting, basic knowledge. 3 main bases of accounting: cash basis, modified cash / modified accrual. I consider those to be the same thing. It just depends who you're talking to. And then the accrual basis. So under the cash basis, which is probably the easiest to use for basic bookkeeping purposes, a company, an entity, an association is going to record its revenues only when it receives money, okay? And they're going to record expenses only when they pay out money for something. Modified accrual is slightly different. Expenses are the same. They're basically recorded when they're paid, but the revenues are going to be recorded when the revenues are actually earned or billed. And that typically for associations is at the beginning of each month, when owner assessments are billed to owners, or when they are due based on a payment structure. Under the accrual basis, revenues recorded when earned, same as modified accrual, but the biggest change is that expenses are going to be recorded in the financial statements when they are incurred, not necessarily when they are paid. It could be that they are incurred and paid in the same month, but sometimes you might have some late invoices that come in the last 3-4 days of the month and are not paid until the beginning of the next month. Those would be included under the full accrual basis, okay? And then remember, I think one of the keys to this whole thing is consistency. You want to make sure that the accounting reports, the financial statements that you're looking at, are consistently presented month to month, period to period. Okay, so I've got this example that is very, very simple, but I hope that it really shows you as participants in this event the real differences in terms of how the accounting basis that's used can really fundamentally change the financial picture. So My little story starts with, hey, if 3 different bookkeepers sat down with the same data, information, transactions to process, would the financial statements that they prepare look exactly the same? And my answer is possibly, but probably not. I did change that when I was scribbling down some notes now, and I guess the big question is, who knows? But you have to be alert and aware to the differences. So the reason why possibly, but probably not, really is assuming that each accountant is accurate and consistent. Okay, they're good bookkeepers, but they may not account for transactions or the activity in the same way or in the same reporting period. And as board members, you typically would be looking at monthly financial statements prepared by your management company, by HOA Community Solutions. Okay. So, and if anybody can't take the excitement in this little example, I apologize in advance, but let's assume that you've got a landscape invoice for the month of November for $2,000. Okay, it's received from the vendor and paid in early December, which is the month after the invoice is dated and the work was done. So what's the difference between cash and accrual accounting for November's landscape expense? Under cash, you're going to record that landscape expense when you cut the check, when you actually pay the bill. So that expense under cash basis is going to be recorded in December when you cut the check. Under the modified accrual basis, it's the same thing. Remember, under the modified accrual, you've got revenue when earned, but expenses only when paid. So it's the same as the cash basis for expenses. Under the accrual basis, you're going to account for the $2,000 November landscape bill in November by accruing that invoice or that expense on your balance sheet and your income statement as an expense and as a liability called accounts payable, or maybe even accrued expenses. Okay, so in that way, that expense is hitting your expense account, your landscape expense account, in the month it should do, when the invoice was dated by the vendor and when the service was provided. Okay, so I've got a little comparison chart here that shows, oh, actually, Tracy, I'm sorry, I think I missed a little bit on the revenues. Could you go back a couple of slides? Okay, there we are. I don't know whether you skipped forward or accidentally, but I want to step back, everybody, and I apologize. Let's also look at the revenues, cash, modified accrual, and accrual. Let's assume that each homeowner's monthly assessment is $100. There's 50 homeowners in the association, that everything's due on the 1st of November. Okay, so you would have budgeted 50 homeowners times $100 each, $5,000 for the month of November. Let's assume that 40 homeowners pay in full at the beginning of the month, but 10 owners don't pay until after the end of the month, so in December or even later. Okay, how does the basis of accounting represent the results of that activity? So cash basis records only the cash received. So assessment revenue recorded is going to be the 40 homeowners who paid during the month of November times $100, which is $4,000. So you're going to be recording revenue of $4,000. Okay. On the cash basis, the balance sheet is also not going to present a receivable for those 10 owners who haven't yet paid. That's not cash basis. Under the modified accrual basis, you're going to record the revenue when it occurs, when it's due to you, which is the 1st of the month of November. So you're going to record the full 50 homeowners times $100, $5,000 in the month. Okay. You're also going to see a receivable of the 10 owners times $100 equals $1,000 for the 10 owners who did not pay on time or didn't pay within that month. Okay. On the full accrual or the accrual basis, it's the same as the modified accrual basis for revenue. Okay. Both the modified accrual basis and the accrual basis will also show that receivable. That's important because we want to start trying to develop skills to link or see trends with balance sheet accounts and with some income statement accounts. Okay, thanks, Tracy. Okay, next one.
Okay.
To the chart. Perfect. Okay, so as you can see, we've got this down on the left-hand column, assessments revenue, landscape expense, and the excess income in each of the four scenarios. So usually when you budget, you're going to budget for the full $5,000 of assessments, okay? And you're going to budget for that $2,000 a month landscape expense. So 5,000 minus 2,000 gives you excess income for the month of November of $3,000. Under the cash basis, you're recognizing $4,000 of assessments revenue. That's 40 people at $100 each who paid in November. You're not going to recognize any landscape expense because you didn't pay that bill until December. So you're showing kind of profit for the month of $4,000. And I wish I could see everybody, because I would love to see the looks on people's faces to see whether you think that's accurate or not, or whether that would help you when you're reviewing your monthly financials if the activity was reported in such a way. Okay, let's jump to the modified accrual basis. You're going to recognize the full 5,000 of revenue. But again, remember, under modified, you're going to use the cash basis for expenses. So no expenses recorded. You're actually going to show $5,000 worth of profit for that month. Under the accrual basis, the fifth orange column, you're going to recognize the full 5K of assessments revenue. You're going to recognize the incurrence of the $2,000 worth of landscape expense, which ends up giving you an excess or a profit of $3,000 for the month, which, funnily enough, matches your budget. Obviously, not every month you're going to have actual results equaling budget, but in this simple example, that's the way it should work out. So as you can see, budget and accrual, you got $3,000 worth of profit just based on a couple of transactions. Cash basis, you got 4,000, and modified accrual, you got 5,000. Those are both, in my opinion, misleading. Okay. Okay, the next of the 5 sections is fund accounting. Associations, condo associations, homeowners, mixed use, typically all use fund accounting to account for your day-to-day, month-to-month operating expenses and revenue, and your separated reserve fund activity, and maybe some other fund needs to be set up. We call it a third fund. That's not an official title, but sometimes associations will sue a developer or something like that, receive some money with which they're going to start paying for some expenses to reconstruct or put right defects and things like that. They'll usually set up a separate bank account and a separate accounting fund to keep the accounting and the financial reporting for that activity separate from regular reserves and separate from the operating fund. Each fund should have its own balance sheet and its own income statement. In a way, they're like separate little entities within the whole. Separate bank accounts are important too. Okay, normal operations, day-to-day type things are going to be run through the operating fund, okay? Typically, I rarely see this, rare to never see anything other than what I'm about to say to you, which is management companies, self-managed associations always do all the billing of assessments to owners out of the operating fund. They record the receivables, the due from owners in the operating fund, things like that. But usually based on their annual budget, they will contribute a dollar amount each month to the reserves fund. And you'll actually move the money from the operating bank account to the reserves bank account. It's really important with fund accounting to try not to cross over funds, not to book activity using, let's say, an expense account on one fund and the other fund's bank account. That creates some difficult to reconcile situations sometimes. Also known as, in my world, as a due to, due from, or an interfund balance. So let's say the operating fund paid a $10,000 reserves fund expense. Okay, so the debit, the charge is going to be to the reserve fund expense account, but the reduction of cash is going to be in the operating fund. So that's going to end up meaning that the reserve fund owes the operating fund that $10,000. So you end up with a little bit of extra accounting, and you end up with a little extra money movement as well to fix that. So it's best to keep them separate and discrete. Okay. I think I have one more thing to say on that. You can leave it on the current screen if you like, Tracy. Tracy, I think you might be giving me a headache.
I know, I'm so sorry. It just keeps jumping all over.
You know why?
I'm so sorry.
Do you have it set on, I think it's manual in the tools in slideshow?
I don't think so.
It's not that one. Okay. And I can't control it. So
I'm so sorry. I can give you control, but
can I control it?
we can.
Okay, it's fine. It's
All
okay.
right. I'm
Okay,
sorry.
So we've covered sections 1 and 2, and now we're going to move to section 3 in the financial statements, which is the balance sheet. A good balance sheet is going to show the reader the financial position of the entity at a given point in time. Now, for board members, that's typically the end of every single month, and once a year, it's the end of that year. But it could be any time. If the accounting is up to date and kept current, you could run your balance sheet any day of the year, and that should show you where you are. So you're going to have your assets, liabilities, and the equity section or fund balance section. It's the same thing. Okay. In the assets section, we're going to be looking at what the association owns or is entitled to. So cash is a big one. Well, the association actually owns that cash. The next little bullet is receivables. That's what you're entitled to. Okay, you've sent out those assessment billing notices, and now you're waiting for people to pay you. So on the individual side, that's a liability. On the association side, it's a receivable, which is an asset. So cash, what are you looking for? We all look to see how much cash we've got. Okay, you're going to see some different bank accounts maybe on the balance sheet: checking account, money market account, savings account, maybe investments, usually in certificates of deposit, maybe treasuries or some other types of investments. You're going to see which fund has the money: operating, reserves, settlement fund. Okay, and again, please ask yourself typically which fund has more money sitting in the bank account. And the answer that I typically see is that there should be more money in the reserves bank account than the operating. Because the reserves bank account, you're saving up money for those bigger ticket reserve study component expenses rather than the day-to-day, month-to-month. Cash should always be reconciled. So bank accounts are typically reconciled every month, usually inserted into the packet that board members are given along with bank statements. I already touched on receivables. Another one that you typically see in audited financial statements, really more than monthly financial statements, is expenses paid in this period that benefit future periods. And a very, very common one is insurance expense. That, let's say it's an annual premium and it's paid in August. Well, 5 months are for this year and 7 months are for next year. So the 7 months you paid during this year for next year are an asset, prepaid expense. I touched on the due to, due from if you cross over funds on the previous slide. So if operating technically loaned money to the reserves fund, operating is going to have a receivable on its balance sheet, and the reserves fund is going to have a payable on its balance sheet. Numerically, the numbers should equal, except one's going to be an asset, the other one's going to be a liability. Liabilities. Liabilities are what an association owes or is obligated to pay. The easiest one to understand, I think, are just payables, accounts payable or accrued expenses. So going back to that November $2,000 landscape invoice, it came in November, but it wasn't paid in December. That's something that was, the expense was incurred, the invoice was received and dated in November. So at the end of November, the association technically owed that to the landscape vendor. So on the accrual basis, that should show up as a payable, as a liability on the balance sheet. Prepaid assessments are kind of exactly what it says, self-defining. Assessments that have been received from homeowners ahead of when they were due. So let's use November again. Let's say 3 homeowners paid $100 each for December, but they paid it into the association in late November. And in November, the association deposited that money. They can't recognize that as income yet because that's December's assessment income. So they have to record it as a liability in a prepaid assessments liability account. Not too frequent, but it does happen quite a lot when an association gets a loan from a bank, some other lender. That needs to sit on the balance sheet as a liability. As a reader, it's really important to read that financial statement and say, oh yeah, we still owe $1.2 million to the bank. I wonder how we're doing on payments. And there's a whole bunch of other questions that come into play on that, especially if there's a long-term special assessment involved and things like that. So be careful with the principal payment or the principal balance versus the interest. Very common, and I think very correct, for associations to budget for the principal and the interest payment, so the monthly payment in its budget, because you're using assessments to make those payments. However, in reality, only the principal balance is going to show up on the balance sheet. The interest expense will be recorded every month when the loan payment is made and will be recorded as an expense on the income statement. Okay, we can move on. Okay, the third and kind of balancing act of the balance sheet is the equity, and it's really what's left over. Typically, it's assets minus liabilities that equals the equity. Another way to look at it, and it's difficult to connect the dots unless you've been doing accounting for a while, but another way to look at it is, over the life of an association, if you added up all the cumulative revenue from day one through today, minus all of the cumulative expenses for the same period, that's by and large going to equal your equity balance. It could be changed a little bit by fund transfers in and out of the two funds, but in total, if you combined operating and reserve funds, it should equal that cumulative revenue minus expenses. Okay. Here's a balance sheet example. And as you can see on the bigger box, top left, under the line, it says assets. Underneath that, it says bank. Just above that, just above the longer line, it says you'll see a column that's entitled operating, a column that's titled reserves, and then the total column. You can see total bank, prepaid insurance, prepaid taxes, then accounts receivable, some other accounts. And at the bottom of that box, it says total assets. And the total assets as of 12/31 for 2020 for ABC condominium add up to $966,000. Then in the small box, we've got the other liabilities I've talked about, prepaid assessments, accounts payable, and then you've got the equity section, total equity, and then This is the way it's usually put together. Total liabilities plus equity equals 966. So liabilities and equity combined should always equal the total of assets. And as you can see on this balance sheet, they do. Okay, the fourth section is the income statement. The income statement is early on in the presentation, I think it was the second slide, we talked about performance, operating performance. So the income statement is going to show you your revenues and your expenses for a period of time. Sometimes the income statement is called a statement of revenues and expenses. Sometimes it's called a budget comparison report or a profit and loss. If you're old school, the profit and loss is the name that most people seem to remember. It's going to report the operational revenues and operating expenses for a period. So current period, current month, or year to date. Most reports for HOAs show current month and year to date results. And they also break them down between your actual results, what was budgeted, what the dollar difference is between the actual and the budget, and what that relates to in terms of a percentage variance between the two. Please always remember, know the basis of accounting that was used to prepare the financial statements, because the three, as you saw in that little example, can really skew what you're reading if you don't know what, or you don't set an expectation as to what you could be or should be looking at. Okay, typical main sections, and we are going to look through an example in a couple of minutes, but the typical main sections at the top, revenues, and you're not going to see assessment revenues tucked halfway down the financial statement. They're always at the top. And then you're going to get to the expenses, typically broken out by category. Often, most of the time, you're going to see contributions or allocations of assessments to reserves. You're going to see a net income or loss, and hopefully you'll see that agreed on the balance sheet, and we've got an example of that for you as well. Hopefully you can start to see some trends. Hopefully, if you have knowledge of what's happened before, you'll use that history to compare to current and have some ideas to what's happening, and be really informed. Very important, I think, even if you're new as a board and it's your first experiences looking at financial statements, is to try and identify what are you expecting to see. You know, if you've been part of the budget building process, or if you've been part of conversations in board meetings, try and remember what occurred and and try and build some kind of expectation. Okay, the revenue section in a little bit more depth. Assessments, again, accrual, modified accrual. The actual assessment should equal the budget, because you're actually billing and you're recognizing assessment revenue as they're billed, which is as the budget set up. Under the cash basis, actual probably won't match budget, simply because in most associations, everybody doesn't pay in the month they're billed. Trends. We've talked about receivables. We haven't talked about cash and how that is reflective of assessments and the balances and receivables, but we'll touch on that again a little bit later. But start to try and picture, if you've billed someone and they haven't paid you, you've got a receivable. If you've billed 100 people and they all pay you in 2 days, you've probably got no receivable and a much higher cash balance than you had 2 days ago. All this stuff's interrelated. And knowing which accounts relate to which, obviously cash relates to both income and expense, but receivable only relates to income. Other income types, we call it compliance, so fines, late fees, interest, violations, things like that. Other example, if there's a cell tower on property, you've probably got a lease going on, you receive payment. Rental, maybe there's a clubhouse or per use rental fees. laundry, move in, move out, parking, just depends what kind of building you have and what sort of ancillary activities are occurring. A tip I think most management companies do is typically you should budget for the known or pretty much guaranteed revenue sources. Don't budget for your contingencies or your unknown revenue types. So you're probably not going to know what kind of fines or late fees you're going to bill next year for people. So probably better not to budget for it. Certainly a lot more conservative to not budget for revenues. Over budgeting for revenues can really get you into a bit of a tight spot potentially. Okay, expenses, as I said a couple of minutes ago, what are you expecting to see? Just really, really important to try and think, okay, landscape every month, $2,000 a month. Utilities every month, varies based on weather, based on usage, based on rates, things like that. What are your trends? What are the prior year trends? What are the prior months? What about the time of year, seasonality? Compare versus budget. Is the actual expense zero and the budget was $5,000? What happened? Well, was it a timing thing? Was the work not done or was something not delivered until a different month from when you originally budgeted? That kind of thing. The general ledger, you should see that in your monthly packet. The general ledger is the more detailed accounting report that typically is going to give you more information regarding what is in each expense account. So let's say it's landscape and during the course of the month you had the regular contracted, maybe you had some brush maintenance, maybe you had some mulch, maybe you had some extra irrigation damage work. So opening up that general ledger, you're going to get a better idea. You're not going to see invoices in there, but you'll see the vendor name typically. And sometimes on the detail, you might get a brief explanation or description of what the service was. I always, don't go back, Tracy, but I always view the general ledger as kind of the roadmap. It's really digging in and saying, here's what happened. And it's, you know, it's easy to shy away from it if you're not used to seeing something like that. At first blush, it looked like a jumble of words and numbers. But if you just take a little extra time, I believe it can be a really useful tool. And not just for the current month, but also for budgeting for next year. And we do a course on budgeting, and trying to build that budget file during the course of the year will so help the budget process as you approach the second half, last third or quarter of the year, preparing the budget for the new year. Reserve expenses, you're not typically going to see those on an operating fund income statement. You might have a separate income statement for reserves, revenues, and expenses. Going to use the reserves bank account, hopefully, to cut checks for reserves expenses. They should be authorized in board meetings, and hopefully there's 2 signatures on the checks. Those dollar amounts are typically higher, and it's really good to make sure that if you're one of the associations that needs to comply with the 2 signatures per one of the acts, that you do so. It's a great check and balance, internal control, whatever you want to call it, to not cut the check and spend the money before the expense was actually authorized, discussed in board meetings. So kind of a quick review of those main sections. Sorry to hammer on about it, but if you switch management companies, you're going to see different types of accounting basis used. And so it's really important that you know, if you came from a management company that was using the cash basis, now you're with one that uses the accrual basis. Understanding what makes that up is kind of important. Okay. Remember, associations tend to account for revenues, expenses, assets, liabilities, and equity using the fund accounting system, separate funds. We all like cash. It's so important in every part of our lives, probably. So make sure you keep an eye on that cash. Is it going up? Is it going down? Maybe have last month's balance sheet open. Maybe have the end of last year's open when you're looking at this month's, and just see what's going on. Operating income and your AR. So I like asking the questions and getting answers, but I'm going to have to do it rhetorically. What happens if you bill $50,000 a month, but only half the people pay their assessments? What's going to happen to your accounts receivable or your assessments receivable balance? Every single month, it's going to increase because only half the people are paying you. So also be careful when you're looking at that income statement. So if only half the people are paying you, but you've recorded your assessments revenue per budget, everything might look really rosy. And the incomes, you keep on spending money and having expenses at the same rate, thinking that revenue looks good. However, if you haven't been looking at your assessment balances going, AR balances increasing, you probably also haven't noticed that maybe your cash balances are starting to decrease. You might actually need to curtail some of the spending, delay it to a future period or something like that. Allocation of assessments to reserves. Remember, all the accounting is typically done in the operating fund for billing and receipts. However, there's that monthly allocation to reserves. Okay, and then we've got the balance sheet here. So I think this is the same balance sheet we saw earlier. If I can direct your attention to the right-hand side, the number with the red circle around it, that's net income. So the equity section, as I said, basically is comprised of life of community, life of association to date, total revenue minus total expenses. However, it's presented, and it's not always presented exactly the same way, but in this case, it's presented to include the current year's year-to-date net income or loss, which is also on the next page, which is the budget comparison or income statement. So remember 17,178, and there you can see your total expenses, your total revenue minus your total expenses for the period year to date equals 17,000. It's a loss of 17,000. I would like to just draw your attention to the layout of this financial statement. This is, I've been referring to it as the income statement. Statement of revenues and expenses. In this case, it's called the budget comparison year-to-date variance report. Really super tool to look at, so informative. So you got top left, you've got the income sections, then midway down, you've got the expense sections broken down by types of expense. And on the top, you'll see the first section is your current month, okay, actual versus budget. And then you've got the year to date, your actual results year to date, and your budgeted numbers year to date, and the dollar variance, the difference between the two, and how that's represented as a percentage. And you can also see in the far right column of each of these sections, the annual amount. And then this is typically the report that we receive from HOA Community Solutions for auditing, broken out between operating reserves, revenues, expenses, and what have you. And the next page will show the same amount, that $17,000 net loss for the year that is combined up into the balance sheet in the equity section. And I think that is it from me.
We've had lots of comments coming in through the Q&A, worried because the slides came through so small on their screens. So I wanted to assure everyone that it is our practice to send out a copy of the recording, but we will also send out, Jeremy, if you're okay with this, we'll just send out also a copy of the PowerPoint, and that way they can blow it up and size it as big as they would like, because I realized this was very, very small to see. So we have quite a few questions that have come in through the Q&A. If we can jump over and perhaps ask some of those, Jeremy, and I'll field those to either to you or to Liz. So the first question is, why is cash basis misleading? It seems like that would be the only true measure.
Well, some people do believe that, and I think there is credence to that. It depends, obviously, it depends how you're looking at things. You know, cash is the reigning monarch of everything. So it's good in terms of, you know, how much money you've got. You know exactly what you've received and you know exactly what you've spent. What it misses is it doesn't show you what is owed back to the association in terms of receivables from people who haven't paid. Okay, because that isn't going to show up anywhere on the cash basis financial. And what if you had a whole bunch of expense invoices stacked up in someone's drawer that hadn't been paid yet? Well, you're going to get the shock of your life the next month when they are paid, and your expenses go up substantially, let's say, compared to that month where maybe they were very, very little. So you know, if it's done really well and timely, yes, it can be very useful. However, in my opinion, it doesn't paint the fullest picture that we should possibly get. It doesn't mean that the full accrual basis isn't without some challenges. You have to keep your eye on receivables because you've recorded your revenues at full balance. But if you haven't been collecting, as I said a few minutes ago, then that's going to impact your ability to pay expenses in the future. I have one other comment, but it's passed by my slow brain right now. Sorry.
You'll think of it. You'll think of it. The next question says, the accuracy of over or under budget depends not only to the type of accounting, but also the accuracy of the budget. If an item is seasonal, the budget is an educated guess. So the result, actual versus budget, may have very little relevancy. I prefer to look what is happening to cash balance going down. Going down is bad and going up is good, usually with a simple business entity such as an HOA. Is this okay?
You know, I think that's great. I mean, I think if you're paying that much attention, that's wonderful. I haven't verified this myself, but I picked this up from someone else's presentation several years ago, that apparently nationwide board members spend a whopping 3 minutes per month reviewing the financial statements. So if you're taking a closer look, whether it's cash, accrual, whatever, I think that's a wonderful place to start. I think whether you're doing full accrual or cash, having some knowledge as to what the other one might be telling you is really useful. So I think keeping an open mind and realizing that both have pros and cons. However, this is the thing I was going to say, Juanita, there's a good reason why the Securities and Exchange Commission that controls all publicly traded companies in the country, or the accounting, reporting, and what have you, and numerous other things, they require full accrual financial statements. That's what GAAP is. And there's a reason for that. You can't kind of hide things. With cash basis, you can hide things. And the other part of that is, let's say you haven't been collecting very well from current homeowners, right? And let's say you had a whopper of a balance that's been outstanding for 18 months, 50,000 or something, and all of a sudden they come into some money and they pay you. Well, that might paper over the cracks as to what happened that month. You might think, oh, we're good, everybody's paying. But it wasn't that everybody's paying, it's just you recovered that one whopper of a receivable balance. So you have to kind of have your wits about you and understand what's going on in several areas.
That makes sense. The next question says, why does the reserve fund show a liability? I don't understand this on a balance sheet.
Okay, and I think that's referring to the contract liability account. And I will try and, I don't know, do we all want to stay up till 11 or 12 tonight? We can talk about this at length if you like. So basically, a couple of years ago, 3 years ago, Financial Accounting Standards Board changed the way revenue is recognized in this country for companies, and associations have followed suit. That contract liabilities account in the reserves fund is basically deferred assessment revenue. So it's reserves assessments that are being deferred until the accounting period when reserves expenses are incurred. It's actually a lot less wacky than it sounds. The name of the account is not a great name, in my opinion. Basically, what they did was they removed the balance from the equity section and moved it up to the liability section, because if you're a company that has a lot of deferred revenue, a normal company, that's where you're going to report it. And the other side of that, the income statement side of that, is that they only want you recognizing the assessment revenue in the period when you have expenses. It's kind of like the matching principle in accounting. For all those lucky people who sat through accounting principles #1.
We had a follow-up question, I think to the last question that you answered, and they said I think it's back to the previous question, but she's saying, but if a bill that you send out is not paid, then you have a liability.
If the association sends out a bill to a homeowner, then and it hasn't been paid by the homeowner, it's going to be a receivable.
I think she's saying it the other way around. If there's a bill to the association that's not paid.
Okay, yeah, so if a vendor, let's say a security vendor or doesn't really matter, sends an invoice to the association and the association doesn't pay it, it is a liability of the association. And at some point, I guess you have to pay it. Yeah.
Okay. All right. Here's a great question. It says, revenues, specifically assessments, rounding results in a slightly different figure over time. How is this handled?
From my perspective as an auditor, I tend to use the term materiality, and it doesn't really impact us very much. That's a really good question. I'm not sure that the financials that your company presents, Juanita, your actuals wouldn't be rounded.
VMS does some interesting rounding. So I know when we budget, it rounds it off quite a bit. So but the actual shouldn't be, but
no. So I think that's one of those situations where just understanding what's happening fundamentally with the system and realizing that you may be a few bucks off, hopefully not too many dollars off.
Okay, and the same individual who asked the follow-up question has a third question, and then we're going to go to raise your hand questions. But the question is, if she's trying to clarify, and she says, if you record an assessment as income and it is never collected, then what? So you were right the first time, Jeremy. She was talking about billing a homeowner. I apologize. I looked down the wrong path.
Okay, no worries. Yeah, so if you bill someone and you don't collect it, and this is, I don't know if this is the same person who was talking about cash basis accounting as well earlier, but this is where, again, no system is 100% perfect. But typically, if there's some reasonable doubt that an association is going to recover the amount that it's billed to an owner, the association, in my opinion, should consider recording what's called an allowance for doubtful accounts, which is a balance sheet account that kind of offsets the assessment receivable account. So the net of the two should always be what you reasonably expect to end up collecting. Okay, and because accounting deals with a double entry bookkeeping, the other side of that allowance entry is bad debt expense. So on the accrual basis, you wouldn't change the revenues. That's what you build, that's what you should keep up there. However, it's offset in the expense section by the amount that you don't expect to recover.
Okay, we have some hands up. We have one question that came in through the Q&A that I think is really specific to an association. So I'm going to have Liz reach back out to that individual directly. But I did see several hands up, and I think potentially some of them went down. But Jimmy Russell, you had a question.
Yes. What I don't understand from our particular financial statement is, why is the budget divided by 12 and is shown as an actual income each month. That makes no sense to me. It should somehow show what the actual funds are received for the month. It just seems like our accountant divides the budget by 12 and say, oh, that's your income every month.
It sounds like you're on accrual, but I'll let
Yes,
Jeremy.
we are on a accrual system, but
Yeah, and that's Jimmy, that's what I've been sort of trying to, obviously not very well. My explanation has been a little unclear. Basically, that's what happens on the accrual basis and the modified accrual basis. You're going to be billing everybody every month based on the budget, which is going to match budget. Okay, and that's why you have to keep an eye on the receivable balances, the AR aging report, and your cash balances as well. And the person who was talking about the cash basis earlier could probably jump in and say, hey, that's why the cash basis is better. You know, beauty's in the eye of the beholder, I suppose. But that's why your actual would equal your budget.
that's why I personally maintain a separate spreadsheet any month, and I account for the payments from each one of our units.
Okay,
But that actual budget makes no sense to me. It just tells me how much money did I get in this month. That's what I need to know.
fair enough. I don't think I need to add anything. I think I've spoken.
Okay. Yeah, I
Unless
understand.
you want me to, Jimmy. I think I covered both sides a few times, probably more than a few times. I have been known to repeat myself.
No, the accrual system is starting to make more sense to me. It's just that apparently I don't have all the information immediately that the HOACS does. And so that's why when I see this these financial statements, it's not as easy for me to understand. With more experience, I guess I'll get there.
Yeah, I understand that. You know, in your monthly financial packet, do you see a delinquency report or
Yes, I
yeah,
see
okay.
that too.
Yeah, good. I mean, at least that shows you who hasn't been paying and how old those debts are.
And that's what I don't understand, how to connect all this information such that the balance sheet makes sense to me. That's what I need practice on, or
Yeah,
need
and
to
then
talk to somebody to,
well, I
make it
know,
clear to me.
sorry, and unfortunately, it's not as simple as just saying, hey, take your total accrual basis revenue and subtract out your delinquencies. That'll show you your cash. That should be the equivalent of cash. You've also got beginning of period and end of period, some other stuff to mess around with. But it sounds like you got a good handle on things, which I think is the most important thing.
Well, the other point, oh, sorry.
Oh, no, it's okay. I was just gonna say, Jimmy, we can always set up a time with you and your manager and their senior manager to kind of walk through and see if we can help you. Because I realize, I know what you're saying. It looks like you're getting 100% of your money in every month when you just look at that from the perspective that you're looking at it. So
Yeah.
we can try to look at that with you.
Okay, thank you.
Mhm. Let's see, we have another question that came in, and Renee has her hand up. So Renee, let me unmute you so you can ask your question. Renee, are you there? Okay, well, we don't have Renee with us at the moment, but maybe we'll check with her again in a little bit. We did have one more question come in that says, it seems like the actual or accrual system requires immediate entry of invoices received. What happens if an invoice is received but not recorded in the system somehow? An invoice could end up in a drawer somewhere.
Absolutely. It's like everything to do with everything we do, probably, but accounting follows suit. If information, data, documents aren't entered into an accounting system in a timely fashion, or with the right transaction date, the right amount, then it's going to skew the reports. So yes, it is important that, believe me, I'm not defending one over the other. I'm just trying to stay somewhat neutral. But it's the same thing. If that invoice is tucked away, even under the cash basis, and someone forgets to pay it, your expenses are going to be understated as well. So any way you look at it, it's if the record keeping isn't very good, the reports are going to be not very good, not very useful perhaps as well.
That's one reason to always scan and send your invoices in right away to Strong Room, because when they reach Strong Room, they are entered with the date that they are received, as well as the invoice date and the due date. So all of that is entered usually within the same day it's received when you send those in to them directly. So. Let's see, Renee, did you still have a question? You had your hand up. Okay, we're not going to hear from Renee. All right. Sorry, Renee, I don't know what to do there oh, here we go. Sorry, she typed her question because I'm trying to unmute her and it's muting her, but she says, my question was to clarify what I said. She said, I did not say cash basis was better, but I wanted to know why earlier in the presentation, you said it can be misleading.
Okay. Yeah. Well, if I can take, I think it was your question just a minute ago, Renee, about the invoice that was tucked away in a drawer, the vendor invoice. You know,
That was me.
I guess as we can't avoid the vendor invoice mishap, but let's say that vendor invoice is sitting on a desk somewhere and it's being dealt with properly, then if it's that November landscape invoice and it's entered into the accounts payable subledger and recorded as an expense in November and a liability at the end of November, then you've accounted for it and you don't have a big fat zero for that expense for the month because you didn't pay that bill until the next month. And to me, that, you know, that's perhaps one of the stronger elements of accrual accounting, in that if it's done properly, all the data is captured, you have a more comprehensive view, because it's not always possible to pay the vendor invoices in the month that the work's incurred or the invoice is dated.
Okay, a couple messages came in, Jeremy, just saying thank you for sharing all of this information. One person asking, is it continued to be Q&A? And yes, that's where Q&A until we've answered everybody's questions now. And Renee is correcting me, and I'm sorry, I made the assumption Renee is a she and Renee is a he, so I'm sorry, Renee. So I owe you a coffee. All right, any other questions? You can put your hand up or you can type them into the Q&A. We will send out the presentation, as I said, so that you can go through it. If you have specific questions, if not understanding something on your financials, do ask your manager to help you with it. And your manager may very well need to pull in a senior manager or myself or Liz. So we're here to help you with any questions. I do see another hand that went up, and I believe that is Raul Campos. And there you go.
The only thing I wanted to say is that the accrual system, if I understand by state law, it's required, isn't it, based on our accounting process that we have to follow as a condo association?
Yeah, the state law has pushed in that direction over the years. So yeah, and again, there's a reason for that. You know, if you compare the two, I think, you know, if you're bouncing around in the middle somewhere, you could probably come down on the reason for going accrual. So yeah, there are some more recent requirements for that.
I have no problem with it.
Pardon?
I have no problem with it, but what I try and do as kind of a supplement, I do manage some cash accounting type spreadsheets to see what's happening on a given time frame, basically, so I can see exactly what's happening and also be able to track back and look to see what's going to happen. And that becomes very important too, especially if you have a property management company that manages everything. It makes it real easy as far as the accrual system, but when it's kind of split, the property management company doesn't always have the insight to see exactly everything that's going on. So as a treasurer, basically for an association, sometimes you have more visibility than the property manager has. So, it becomes kind of a responsibility on the individual to, kind of track that and help the property manager out. So I think that becomes very important when you have to look at it from that perspective.
Yeah, good comment, Raul.
Very true. We had another question come in, which is a great one. Do either Jeremy or you or Liz, do you have any textbooks or good articles that you can share that really explains the accrual system? Some people can read it, more than auditorially and digest it.
There, I need to look, but if anybody wanted to go on to the CAI online.org website, it's the national CAI website, there's some really good publications that CAI has put together over the years. I'm not sure that anyone specifically addresses accrual basis, but there's a treasurer's book, there's various things. If you go online and just Google accrual accounting, you'll probably see a variety of things that are going to give you some different words to describe the same thing that may give you one of those aha moments, if I can say that correctly. I don't have anything specifically in mind, but there's loads and loads of books, maybe a basic principles of accounting, or even not to be rude to anybody, I think there's one of those for dummies series books on bookkeeping.
Hi, Jeremy. This is Liz. That's a great textbook to use, the Accounting for Dummies. And it really does walk you through very, very clearly the differences in the accounting. And it also helps to show pictures, and it shows the various, why you are why you're looking at things differently, and why you would want to look at your accruals, and why you want to look at those. So when you present the financials, it's a great book. I'm using it with staff here as a basis, and it's written very simply in very short chapters.
Great, thank you. And we can see if we can pull out some articles, and when we send out the presentation materials and the recording, we can also send links to maybe any of those articles that we find. So great. Okay, I don't see any other questions. Oh, wait, something just popped in here. Several people just saying thank you, Jeremy. They really appreciate it, and they're looking forward to getting the PowerPoint. Anyway, another thank you for you taking your time tonight. So
Wonderful. It's been my pleasure, and thank you for inviting me, Juanita.
Absolutely. All right. If there's any other questions, we'll entertain those. Otherwise, we will let you go a few minutes early tonight, and you'll get 20 minutes back to your evening. I do want to, Tracy, I don't know if you can pull up the slide for our next webinar, but I would like to just give people a heads up. As you know, we're trying to do these on a regular basis. So we do have a webinar planned for May. I believe it's May 17th. And it is is your community looking tired? So if you are one that may feel like your community is looking a little bit tired or a little bit run down, you might want to participate in this one. So this is May 17th at 6 p.m. And the presenter is going to be Dean Pody at Pody McDonald. So we'll talk a little bit about just some of the things you can do to kind of keep your community looking fresh. So, all right. I appreciate everybody's time tonight, and I wish you a wonderful evening, and thank you for joining us, and look forward to talking with you or seeing you on or at least seeing your names on the next webinar. Have a great night. Thanks, Jeremy. Thanks, Liz.
Thanks, Juanita. Thank you. Bye.
Have a great evening.
You too.
Thank you.
I wasn't for it.